So we thought of getting you somebody who understands macros very well and fuses them very well with financial markets. So we have Maneesh Dangi joining us now. Maneesh, afternoon. Thank you so much for your time. Let's start with the two recent points which is making markets a bit nervous. One is that news flow coming out of China. There seemed to be some nervousness and urgency among the policymakers there, be it capital market, be it cutting rates is concerned. And on the other hand, the extremely strong data set coming out of US, the economic indicators. How are you reading both of these?
So Ajay, it's right. In China, of course, there is a serious struggle with respect to the growth model itself. So while policymakers are trying to address the financial part of it, which is, don't sell stocks, ease interest rates, and so on and so forth, the real worry in China for the last couple of years and over next many years and perhaps a decade would be how to change the growth model. And we still don't hear anything from them yet in terms of how they're going to lean against investing-led, growth model to consumption-led. It's still a sort of a thing which is not very sure. So China is going to sort of over a medium term will continue to disappoint. But then relative to market expectations, when at least in India, general popular view would be that, China is of course in a doom loop and, perhaps is having a recession. That's not true. China is likely to grow at 4-5% over next many years. So which is great for the size of economy it is, but relative to erstwhile expectation, it's not that great. That's on China. On US, actually, the opposite is true. The hard data continues to surprise markets on the higher side, also to the policymakers. The good news there, of course, is that the inflation is dropping, but markets are circumspect whether a durable 2% inflation would be achieved in next 6 to 12 months' time. I am of the view that they would get there soon, but would the economy slow enough to secure the 2% is what markets are circumspect of. So in a sense, China and US actually, relative to what we have seen over the last 3 decades, is in a very, very different and opposite context. You could see China is struggling, whereas, US, despite tightening so much, economy seems to be, at least from a hard data standpoint, seems to be doing all right.
Maneesh, what does, the hardening of global yields, US yields in particular, and the dollar index going to 103.5 closer actually mean for flows into emerging markets, even India, which are a big beneficiary? Is that a risk of reversal?
Yeah, absolutely right, Ajay. So basically, we have to understand from the point of view of, that why US rates had to tighten so much, until sort of COVID happened, everyone thought that the neutral rates in US are 0 and take Fed rates to 2.5%, then economy would begin to puke. We are at 5.5% today, and still economy seems to be chugging along, largely because the fiscal has been pro-cyclical. In a sense, government has been spending a lot. Now, this creates a sort of a unique kind of setup. When fiscal actually lays a little bit of a safety net to the economy at large, monetary policy has to tighten significantly more. Now, US does not do very badly because of the balancing factors, which is, loose fiscal and tight monetary policy. But then rest of the world, most specifically emerging markets, begin to struggle because for us, the sovereign rate, or let's say you could call US central bank or US rates as the rates of the world, they are very, very high. And that tightness, which is not impacting US much, begins to actually leak into the world at large and actually begin to sort of hurt economies by way of what? By way of actually weakening currencies. And this is what we are seeing across emerging market, most specifically China, where actually yuan has actually weakened quite dramatically over the last couple of months.
The other thing I want to understand from you, Maneesh, is the way stance of global central bankers have changed in the last, say, a month or so, including our own central bank. From accommodative, of course, but he has introduced a line of, we are keeping our options open, as if telling the market that the possibility of another rate hike is back on the table. And even the market, for that matter, had started assuming that it was a pivot. But now it seems to be the case that it's a pause, not only globally, but domestically as well. Is that change of stance fully priced in by financial markets or not yet?
So local rates actually have backed up quite a lot. Swap rates are actually now pricing a marginal rate hike versus about few cuts less than 2 months ago. So to that extent, complete U-turn has happened from markets perspective, and rightfully so. I've made this argument many times that India actually faces a little bit of a inflation conundrum. In a sense, while rest of the world, more specifically in US, and also you're seeing in China where deflation is there, very likely inflation will actually surprise you on the positive side. In a sense, lower inflation. India is going to see a reverse setup because of the political cycle. A large amount of this largest, fiscal largest at center as well as at states is leaking into the economy and converting itself into food inflation. We've seen this sort of picture run before in India, and something similar is likely to happen over the next couple of months or couple of quarters rather. So in a sense, Indian inflation, is going to have a unique feature where it is perhaps likely to be rather stickier than and at higher level, largely because of food inflation, where central bank has little control of. But because RBI targets CPI in aggregate, if it's going to be above 6%, which is likely, it's very likely that RBI will keep the stance very tight and perhaps will deliver a few cuts if at all. Which is why I was never in the camp that Indian rates would ease at margin even 6 months ago.
Maneesh, let's put all of that in perspective for Indian investors, especially the ones who are more active on the risky assets in equities. Where does this current environment actually, put risk or loading risk right now? Should one be fully loaded risk, or that best time when risk was very juicy, maybe in March or thereabout when you were speaking, when you actually went completely full in and you said that very clearly that this is the time to dial in risk. Now that things have moved on, how much tilt would you have towards risk and how much towards risk-free?
So Ajay, Indian markets are trading markets in a sense. If of course there is a little bit of a macro tailwind for India, and so if market sells off dramatically, there's always a time to sort of trade markets. But then for investors, who are actually looking at very long-term investing, for last 2 years, I made this argument that valuations are expensive, macro is not that great, and which essentially means that risk premium available to Indian investors is not significant. That sort of remains true even today, despite reasonable corporate earnings of last quarters. Valuations in India are still about 19-20x of expected earnings over next 1 year. And that's not very juicy, relative to past, from price to book standpoint, Indian markets are 15-20% expensive. Price to earnings, about 5-7% expensive. Relative to US, they're reasonably priced now because US also has become very, very expensive. But then remember that all markets are eventually priced at US dollar and US treasuries. And treasuries are very, very juicy at 5.5% US dollar. So everything has to sort of price above that. And so therefore, I am of the view now that both S&P 500 and Nifty at margin over next few months would actually disappoint relative to bonds. So I think from a pure global investor point of view, it's time to sort of dial long treasuries in US. But in India, if you're only a local investor, sort of makes sense to, in a sense, say neutral or somewhat underweight in Indian equities.
We'll let you go on that one. Thanks so much for sharing your thoughts out there. That's how you digest macro and market. Both are important, and you need to keep taking stock of macros every now and then if you are really managing your portfolio in a very active manner. And that was Maneesh Dangi of Macro Mosaic helping us to write exactly that.